Investor Kevin O'Leary is incredibly successful and estimated to be worth over $400 million. I'd say that's a low estimate too. He's best known for his role on the hit business show Shark Tank, of which I'm a big fan. However, what you may not know is that Kevin loves investing for dividends. So much so that he launched his own ETF focused around quality dividend-paying companies. Throughout this video, I will explain why Mr. Wonderful loves dividend stocks, and I'll analyze his O'shares Dividend ETF. Let's roll the intro. My name is Zach, this is Dividend Data, and you should leave a like and subscribe to the channel if you enjoy the video. Here I analyze and do research on dividend stocks, and every month I give you an update on my personal dividend growth stock portfolio. Plus, I created the best stock research tool for dividend-focused investors. That's available on dividenddata.com, and if you sign up today, you can get 50% off for life. This is the best deal we will ever offer, link in the description and pinned comment of the video. Today I'm going to share one of the most passionate cases for dividend investing I've ever seen, and that comes from Kevin O'Leary. But rather than have me explain Kevin's philosophy, let's hear directly from Mr. Wonderful himself.
My mother used to take a third of her paycheck and put it into large cap dividend paying stocks and corporate credit back in the early 60s. And when she died, this portfolio had existed for 50 years. And as an executive, the first time I got to look at it, she'd hidden it from both of her husbands. It was amazing. If dividend-paying stocks and corporate credits over 50 years, you can't find an index that beats that. And so when I started to do some research, I found out one interesting fact that changed my investment philosophy forever. Over the last 40 years, 71% of the market's returns came from dividends, not capital appreciation. So rule one for me is I'll never own a stock that doesn't pay a dividend, ever. If you look at the volatility in the market around names that don't pay dividends, they're extremely volatile because there's no cushion of yield. What's the value of a stock that never returns capital to its shareholders? I don't know. Because the only way you can make money is if somebody else is willing to buy that position at a higher price for some emotional reason, perhaps, or for some, foresight that maybe the company will return capital one day. And I think of, when you learn as an investor over multiple decades is the only thing that matters is free cash flow. That's it. There is no other reason to own a stock. And with that philosophy, it brings you into a place where you focus on a company's ability to generate incremental cash flow, because just owning a dividend-paying stock is not good enough. Because, let's say we find a stock today that's paying a 3% dividend yield, and tomorrow, because its forecast for sales get cut in half, the stock drops by 50%. Now it's yielding 6%. I don't want to own that stock either. So my tests in this index that I've created with FTSE Russell looks at the balance sheet. Every year we test to make sure that the company is viable in its ability to generate cash. This is extremely conservative investing. This is for the long haul. These tools are not for, as you're suggesting, for spicy, the hot stock du jour. I've done that. I've been there. Let the young legs do that. I have zero interest in that. I don't care what the hot new stock is. When a company comes public, I won't own it either. It's got to prove to me over multiple years that it can continue to generate cash before it even fits into what I'm doing. So I'm really boring, and I like it that way. We're talking about real money here, the stuff that you need to preserve. When I think about my family trust, I can't afford to mess around with that. In my world, you never touch your principal. You adjust your spending habits, your gifts to charities, your use of capital based on how much you can generate from your portfolio. I view my portfolio and my trust and my positions as a chicken on a spit dripping cash. Everything has to generate yield, whether it's a fixed income position or an equity. It has to, the only reason it can be in my world is it's generating capital back to me. I take that, I disperse it. The family lives off that, the charities I've committed to. So I'm always looking for a company that can help me with my problem of generating more yield. I can't even imagine buying a stock that doesn't pay a dividend. Why would you do that? What would be the reason you would do that? I don't get it. So to me, that means about 28% of the market, to me, is just speculation. A stock that doesn't pay a dividend is a speculation. It's not an investment. You look at companies that don't pay distributions, don't return capital, how risky they are. Take a GoPro, for example. I'm not just picking one company, I'm just giving you a good example of a company that basically has lost 70% of its value, never returned a dime to shareholders. Or how about a company that's been around much longer, Yahoo? Never paid a dividend. It's never made money for anybody except all the CEOs that have gone through there and got whacked. It's just a rotating door where management extracts capital, never returns any to shareholders. And I look at that and say to myself, why don't I just avoid that altogether? If it doesn't pay a dividend, I know that 71% of the time all the returns come from dividends. Why should I own a stock that doesn't pay a dividend? And I never will. You remember back in the late 90s, I'll use one example, Toys.com. I was an investor in Toys.com. I went to zero, never made any money. And I grew a little 4-inch Charlie Munger on my shoulder when that happened. And he appears, you can't see him, but he's on my shoulder every time I'm getting pitched a deal like Lyft or Uber. And Charlie says only one thing. If it has no cash flow, just say no. And I have listened to my little Charlie ever since the late 90s, and I've been right 100% of the time. This company is valueless. It doesn't have any cash flow. It's a speculation.
Let's summarize some of Kevin's major points. Cash flow is a priority when making investing decisions. This makes sense because free cash flow is the only real way to return capital to shareholders. As Warren Buffett likes to remind people, a share of stock is just a small ownership stake in a business. Therefore, the principles that apply when buying a stock are the same as if you were to own a whole business. You need to produce a profit and you need to get a return on invested capital. If you can't consistently generate positive cash flow, then there's no money to return to shareholders. There's no profit. The only other way is to try and sell the business to someone else for more, who themselves would hope to eventually see a return, or sell it again to someone else. As Kevin says, that's speculation. Ultimately, if your business has no path to generating cash flow, then it has no value to long-term shareholders. Kevin uses this line of logic to support investing in dividend-paying stocks because a dividend is the only reliable vehicle through which a shareholder can see a return without selling some of their position. He also uses the statistic that 71% of total market returns are from dividends, not capital appreciation. While this video is outdated, so the exact stat may be slightly different now, the principle still applies. Since January 1993, the S&P 500 has seen a 2,290% total return. And during that time, the price return was only 1,238%. So that's a big difference from reinvesting dividends. 2,290% versus 1,238%. And the impact of dividend reinvestment is best seen on a long time scale. However, it is still notable even over the past 10 years. The 10-year total return of the S&P 500 is 241.31%. The price return was just 186.13%. 241 versus 186. So on a long time scale, dividends and reinvesting those dividends really matter. But if we go back to Kevin, he's also very focused on preserving the wealth he already has. So he wants stability and diversification. It's for this reason that he designs his ETFs with this in mind. So let's hear how Kevin describes his OUSA ETF, and then I'll come back and give my breakdown and compare it to other popular ETFs and the option of investing in individual stocks. So let's hear from Kevin.
Hi, I'm Kevin O'Leary from Shark Tank and chairman of O'shares ETFs. Many people ask me about investing and the ETFs I have in my portfolio. Here's how I invest in U.S. large cap stocks. OUSA, an ETF with over 100 large cap quality dividend stocks. It has given me great performance and dividend income. I don't want all the 500 biggest companies, just the higher quality companies. So I own OUSA. Here's the best part. I get performance that has kept up with the S&P 500 with 30% less downside during stress events. This is a U.S. large cap ETF that I helped build and is in my portfolio.
All right, so that was a nice sales pitch from Kevin, but let's actually look at the O'Shares US Quality Dividend ETF, ticker symbol OUSA, and see what they own. I'll also take a look at their fee structure and compare their total return to other popular dividend ETFs like SCHD and, of course, the S&P 500. OUSA currently has 99 holdings with $818 million of total market value, so it is a pretty small ETF relative to some of the large index funds. And if we take a look at their holdings, you can see it's a bunch of high-quality companies, some of which I own in my dividend growth stock portfolio. For example, here's the top 20. We have Home Depot at 5.38%, Visa at 5.36%, Apple at 4.99%, Microsoft at 4.8%, Johnson & Johnson at 4.28%, Alphabet at 3.99%, MasterCard at 3.98%, Merck at 3.97%, Comcast at 3.77%, McDonald's at 3.38%, Cisco at 3.09%, Accenture at 2.79%, Procter & Gamble at 2.64%, Texas Instruments at 2.38%, and rounding up we have other popular dividend growth stocks like United Health Group, Lowe's, Abbott, etc. So overall, if we just look at this as a basket of companies and quality businesses, I'd say this is a pretty good grouping. And overall, the downside risk is pretty low with these companies. The current dividend yield based on the dividends they paid over the trailing 12 months is 1.49%. So in terms of dividend yield, that's pretty low, but it is higher than the S&P 500. But again, this ETF isn't focused on high yield. It's focused on quality businesses that reliably pay and grow dividends. Over the past year, OUSA has a total return of 24.23%, which, hey, that's not bad. That's pretty good. The 10-year total return is 165.43%, which is lagging the S&P 500 significantly. And yes, that is accounting for reinvesting dividends. The price return in that time was 116.29%. If we go back to the S&P 500, the 10-year total return was 241.31%. It should also be noted that OUSA has a 0.48% annual fee. That means every year you're losing 0.48% of your value. And these fees are a big reason why I avoid mutual funds and even some ETFs. It may not seem like much, but this slowly eats away at your long-term compounding. So not only are the total returns in the S&P 500 much better, but the expense ratios are also typically much lower. For example, VU from Vanguard has a 0.03% expense ratio. So if your goal is total return, then I would stay away from OUSA. However, to give Kevin credit, I do think this is a nice basket of companies, and they do fit his goals of consistent and growing dividends. But if you do want a dividend-focused ETF, there are better options, such as the Schwab US Dividend Equity ETF, ticker symbol SCHD. This is more focused on yield with a 3.45% distribution yield over the trailing 12 months. Plus, it has a much lower expense ratio at 0.06%. Here you can see the current holdings of SCHD. That includes BlackRock at 4.58%, Cisco at 4.49%, Chevron at 4.41%, Bristol Myers at 4.37%, with other holdings including Home Depot, Verizon, Texas Instruments, UPS, Altria Group, Lockheed Martin, PepsiCo, Pfizer, Amgen, Coca-Cola, AbbVie, etc. Now, looking at this purely as a basket of companies, I actually think Kevin's OUSA may do better moving forward, but these all do change over time. For example, SCHD tracks the Dow Jones US Dividend 100 Index. Over the past 10 years, SCHD has seen a total return of 196.9%. And here you can really see the impact of reinvesting dividends because the price return was only 115.12%. But personally, I like to pick and invest in individual stocks. This is a much more active approach and does require you to be very involved and follow your investments. So it's not an approach for everyone, but you can't avoid the high fees of something like OUSA. And I find stocks to invest in by looking for companies with very high and growing free cash flow that at the same time pay reliable and growing dividends. And some of these in my portfolio are high yield, like the Altria Group, ticker symbol MO. From reinvesting dividends, my yield on initial cost is 11.23%. But then I also have low yield stocks like Visa and Microsoft. Overall, I'm optimizing my portfolio for total return, but other people are at various phases of life, and some people need the higher dividend income right now. Now, what I will say about Kevin O'Leary is that he sometimes can be a hypocrite. He's quite the salesman, and a lot of times will just say whatever makes makes money. He does not exclusively invest in dividend stocks. Just in recent history, he's voiced support for Bitcoin, investing in watches, and countless non-dividend stocks. However, I will give him credit, he does have a large chunk of his net worth in dividend-paying stocks. So to an extent, he's putting his money where his mouth is. And before I wrap up, I just want to remind everyone that dividend investing is not a religion. Fundamentally, what we're doing is just investing into businesses. There are many strategies to build wealth, and investing in high cash flow, dividend-paying companies is just one of them. And it certainly can be a good addition to your portfolio if you want a reliable stream of growing passive income. Thank you for watching Dividend Data. If you enjoyed the video, please leave a like, comment, and subscribe to the channel. And if you want to use the best research tool for analyzing dividend stocks, then sign up at dividenddata.com. I just launched our new AI investment analyst. Think of this as ChatGPT, but specifically trained for stock analysis. If you sign up today, you can get 50% off for life, which is the best deal we will ever offer. Click the link in the description and pin comment to get 50% off. Thanks for watching, and I'll see you in the next video.